Kia ora koutou katoa. Welcome to today's podcast. My name is Lindsay O'Connor, and I am the head of local online solutions at LexisNexis. As part of my role, I am responsible for the creation and development of our legal and regulatory compliance products. I am delighted to be here in Wellington today and joined by Lyn McMorran, who, as many of you will know, is the Executive Director of the Financial Services Federation. Today, Lyn and I are going to be talking about financial compliance within the New Zealand legal landscape. Now, Lyn, many of our listeners will be very familiar with you and the work of the FSF. But before we jump into a discussion about some of the developments within the financial compliance space, could you give a very quick overview of your role at FSF and also a little bit about your background before you joined FSF?
Certainly. Kia ora, Lindsay, and thank you for asking me to be part of this podcast. Apologies for the Wellington weather. You should have been here last week. That's what we say to everybody. The FSF has been around for the last 50 years or more, in fact 55 now. We represent responsible non-bank lenders. So our members are finance companies, lending to consumers, they're lenders to business, they're leasing companies, they're credit-related insurance provider members. We've got a number of members who are affiliates who provide services to the financial services sector. And we basically represent them to government, to the public, just effectively anyone that needs to know that there is a responsible and really effective non-bank lending sector and an alternative to the traditional banks. My background is in banking, so funnily enough, I now work for the non-banks, where previously I was with Westpac Private and head of their private bank area from basically Wellington South. So yeah, it's a pleasure to be here. And I guess what is happening at the moment in the financial services sector is a lot. And I think that we're not alone in that most sectors of the economy are finding that there is an awful lot of government regulation coming down the line, but it feels to us sometimes like we get especially hammered. There's major changes, of course, to the Credit Contracts and Consumer Finance Act, as you will know. But in addition to that, there are things like requirements for financial institutions to report on their climate change issues.
Of course.
There is a regime coming out that is going to require conduct standards and fair conduct programs within financial institutions that our members are also concerned about. There's changes coming to the Deposit Takers Act, or a new Deposit Takers Act, which will affect our non-bank deposit takers. There are changes to the insurance contract law that we can expect to see before the end of the year, and that will affect our credit-related insurance provider members. So there's certainly a lot happening.
There's plenty happening there to keep everybody within the industry busy, isn't there? So I know many of our listeners are going to be familiar with the Credit Contracts and Consumer Finance Act, as you just mentioned. Now, since that act received assent back in 2003, there have been many amendments, I think it's fair to say. However, in 2020, it seemed like we saw a particularly high volume of changes, and some of those made very significant amendments which came into force. So I wondered if you could start by giving us a quick overview of some of the key changes for your members within that act.
Sure. So the Act itself, the 2003 Act, was reviewed in 2015, and concepts like the lender responsibility principles were brought in at that point, and the Responsible Lending Code was developed at that point. This new round of changes that, as you mentioned, has been now enacted and will come into force on the 1st of October, actually takes what was a fairly principles-based approach to the Act to a very prescriptive level. And we have questioned all the way through the process as to the need for this, because it is our view that the law as it stood quite clearly prohibited lenders from lending to people who couldn't afford to repay. So if there was harm being caused to consumers, particularly those who might be in more vulnerable situations, by lenders who were lending to people and putting them into debt situations that they couldn't get themselves out of, that there was probably a clear breach of the law, and that the answer wasn't more regulation, it was enforcement of the law that we had. Unfortunately, the government didn't take the same view, and so we've gone down this path now where a lot of the guidance that was in the Responsible Lending Code previously is now in prescriptive regulation, particularly with respect to advertising of credit, particularly also with respect to the assessments of the suitability of the loan product for the customer's goals and objectives. And the other thing is very, very much on the the way in which the affordability is assessed. So where lenders previously might have been able to use judgment based on years of experience and particularly also years of experience with a particular customer, they're now going to have to ask for a lot more verification.
I mean, that sounds like quite a radical change for people within the industry to adapt from something that effectively was guidance, but now is very definitely regulations and has to be done. How are your members coping with those kinds of changes?
I think it's fair to say that they feel that they're under an awful lot of pressure, and I would be actually quite concerned about the stress levels for some of our members.
Absolutely.
In terms of, because the deadline for being across the line is 1 October.
Yeah.
And as you mentioned, some of the regulations and certainly the updated Responsible Lending Code didn't land until the end of February this year. So the window to get systems changes, and you know, as soon as you go from principles-based to prescriptive, it requires massive systems change. To get all those through, to get documents updated, to get the professional advice they need, to do the staff training they need, all of those, the entire project is massive, even for the most responsible of responsible lenders. So yeah, we are really concerned with that date. We are concerned that it's a very hard date for the enforcement of the new law, because the new law also carries with it extensive personal and business and organisational penalties if they get it wrong. And I just think that we would like to see the regulator, the Commerce Commission, take a light-handed approach in some cases. Post 1 October, if they go into a business and see there is a clear project plan, there are clear milestones that they've already met, but there has just been an inability due to lack of resource or lack of availability of the right people or whatever, because everybody's scrambling for the same systems analysts, the project managers, legal and compliance people. You know, if there's a clear willingness to be compliant and there's a clear project to get there, but they just can't get over the line come 1 October, that they would give them a little bit of a grace period. We're not getting a sense from government that that's what they're expecting.
I was just about to ask for that, because one hopes that they take a sensible approach. But of course, once it's actually in the legislation with strict penalties, there's no guarantee that that necessarily will happen. That
is a real danger about which we're extremely concerned.
So do you feel like your members are getting a lot of kind of support and lots of information around how they can help ramp up their efforts to be compliant?
I think it's one of the reasons why the FSF membership has increased quite considerably just recently, and we're still receiving inquiries from consumer lenders who would like to become part of the FSF because of the information that we provide. So we do weekly newsletters and weekly updates, but most significantly we had one of our legal affiliate members, Chapman Tripp, prepare for us a very comprehensive compliance plan and checklist that goes through the Act clause by clause, all the changes in the Act clause by clause, all the new regulations and all the underlying guidance from the Responsible Lending Code in a really comprehensive and really clearly set out way, so that you can go through and tick off, yes, we've got that covered, and this is the evidence that we've done that. This is what we need to be concentrating on in terms of being able to prepare our compliance plan. That sounds like exactly the kind of practical guidance that people will need to support them through that period. Yeah. So that's really great to hear. Now, I understand that Australia is currently looking at relaxing their responsible lending laws, and essentially this seems to shift some of the responsibility from lenders over to consumers. Does Australia's direction here affect New Zealand in any way? And what are your kind of views on that sort of shift? It's quite extraordinary to us, because normally the way things tend to work is that New Zealand tends to follow Australia. So Australia puts in prescriptive or comprehensive regulation, and we have a look at it and think about how it might work in New Zealand. And usually we come up with a more sensible approach. And it's always been sort of something that we've been quite proud of when we talk to our Australian colleagues, that New Zealand sort of manages to come up with 30 pages of regulation as opposed to 300. And tries to simplify things. We've gone in totally the opposite direction this time, which is quite extraordinary. So the Australian government's recognised the fact that access to credit is really important for the post-COVID economic recovery, and that's for both consumers and businesses. And their proposal is basically to go back to scratch with their consumer credit laws and essentially just go back to the founding principle that lenders must lend responsibly.
Wow.
whereas we're going through this whole prescriptive approach, and we are very concerned that it will inhibit access to credit. And, that I think for New Zealand's economic recovery post-COVID is not a good thing. I think one of the things that really concerns us is the fact that consumers are going to have a very rude awakening come 1 October, because I don't think that they're aware of the changes that are coming. And I think what that means is that they will rock up to their Harvey Norman store or go into a motor vehicle dealer or whatever, thinking that they can access credit to buy a new TV or a new vehicle or whatever it is that they want in the way that they've always done, and they'll be asked to go away and bring back a suitcase full of pieces of paper or whatever, or, bank statement information and verification to be able to get hold of it, even if they're a repeat customer.
Yeah, I mean, that's going to be quite a change for consumers. And as you say, I think where we have lenders themselves actually struggling to keep up to date with requirements and changes, consumers are really not going to be aware of this at all until it actually happens.
Yeah, no, I don't think so. I don't think they will, and there doesn't appear to be any kind of public awareness campaign. And I think too, back to your point that you made just before, Lindsay, one of the things that the Act has done is repeal the principle that allowed lenders to rely on the information that was provided to them by the borrower, provided that the information looked reasonable.
Yeah.
And that seemed to us to be perfectly reasonable.
Absolutely.
Because a loan contract is a two-way thing, and there are obligations on both sides.
Yeah.
And we've always said, yes, there are responsibilities on lenders to not lend to people who can't afford to repay it. Absolutely, we understand that, and so there should be. But there are also obligations on the borrower to ensure that they are not that they are disclosing everything that they should disclose, that they're not taking on debt that they really can't afford. And also we sort of think, well, the other thing is that if a loan is declined, then the borrower should start looking at other alternatives or seek financial mentoring or something, as opposed to keep on going until they find the path of least resistance and end up in a high-cost credit contract that they can't afford. And so we actually wrote a responsible borrowing code that we distribute through our members and also through financial mentor networks, just spelling out those obligations. And I don't think that this new law changes those obligations on the part of the borrower either, to be fair. I think it is still a loan contract and there are two parties to the contract. Definitely. And things like for borrowers not pretending that nothing's happening if they are getting into financial stress or whatever. And we saw that through the whole COVID thing, with people coming to our members proactively saying, I'm concerned about what might happen with my situation if I lost my job, or I have lost my job, what can you do to help? And we saw the non-bank sector step up and provide real assistance to those people by extending payment terms and deferring payment and all that sort of thing. And they did that without the same level of legal support that the banks got.
Yes. Yeah.
So, I think what they demonstrated at that time was a real willingness to work with customers when they're in hardship. So we do have a very close relationship with the FinCap, the National Network for Financial Mentors, and we work with them really carefully or really clearly to point people in their direction when there are situations like loans are declined or the person starting to experience stress.
I'm very glad you brought up COVID, Lyn, because I was going to ask you more generally about the impact of what was a very strange year last year on specifically your members, but also on that lending-borrower relationship, because obviously there have been some interesting economic times, and I imagine pressures put on both parties during that period.
Sure. Yeah, to say it was an extraordinary time, I guess, is an understatement for everybody, not just the financial services sector. I think one of the first things that we were really pleased to be able to do for members was to get financial services declared as an essential service, because we could see that if people were going to be struggling and there was, the effect of the lockdown was going to be that people lost their employment and all of that sort of thing, there was going to be a need for our people to be able to able to deal with that. So that was the first thing.
And that was done very early on.
That was right in the very beginning. Sort of as soon as the lockdown was announced and people started thinking about what was an essential service. So your supermarket was, and so too was financial services, which was a good thing. Then the floodgates opened and the calls just started coming in, and we started tracking that right from the very beginning in terms of, what was the number of calls that members were receiving in terms of requests for assistance, and then how many loan contracts were being varied. And it was just massive to start with. But it tailed off really quickly, and that was really interesting to us because throughout lockdown, even throughout the second and third lockdowns that Auckland has undergone, we haven't had another spike like that in those sorts of requests for assistance. But when we got them, our members just responded immediately. So the banks had their mortgage guarantee, their mortgage deferral scheme put in place, and they had legislation around that to allow them to do that. We just got on with it and did it because it was the right thing to do. So our members were putting loans onto interest only, reducing payments and extending the term, or deferring payments altogether, depending on the customer's circumstances. But a lot of it turned out to be people just asking what the situation would be if something happened to their job. And as it turned out, with the wage subsidy and things like that, the worst didn't actually happen. And so what we saw as soon as we came out of lockdown was, obviously during lockdown, people couldn't get out and go shopping and that sort of thing. So loan originations largely dried up. But once we came out of lockdown, people went out and started spending again. And I think too, the fact that people couldn't travel meant that they just went out and bought stuff for the house or bought a new vehicle or did whatever they needed to do. And so loan origination volumes went back to pre-COVID levels fairly quickly. Then on the other side of the book, you'd be thinking, well, if people did lose their jobs and, people in the hospice sector or tourism or whatever have lost their jobs, then surely arrears and defaults have gone up. The short answer to that is it doesn't seem to be. It still hasn't worked its way through, and we expected, obviously, with the end of the wage subsidy,
that
we would start.
The impact,
that's right, exactly. We would start to see that, but we haven't to date, and it seems counterintuitive. But I guess the main thing is long may it last.
Absolutely. It seems a hallmark of Kiwi resilience, perhaps. But I think also the fact that people prepared early and also prepared for the worst right at the back of the crisis. And almost then, we over-prepared, and actually all of those resources haven't to date been necessary. Long may it continue.
Exactly.
So just to switch back onto financial services quickly, Lyn, how are your members handling more generally their regulatory compliance obligations, so over and above things like responsible lending laws?
I think there is a feeling of being overwhelmed. I think, there is a feeling too that New Zealand's financial services sector has been extremely resilient over the period of COVID. And we've shown an ability to step in and assist customers when they needed it. We've shown an ability to continue to manage our loan books extremely well so that arrears are low. But I think there's still this ongoing barrage of financial regulation that's just completely overwhelming. And you look at something as significant as the Conduct of Financial Institutions regime that's planned, and there's 2 consultation papers out now for submission around what that will look like. And you think, well, really, what is the problem we're trying to solve here? I think we have demonstrated, and not just in the non-bank sector, I would include the banks in this too, we've all demonstrated a real willingness to work with customers for the best possible outcomes without needing to be regulated.
And that seems to have been the case more than ever in the past year, where actually really good outcomes have been achieved through both parties working together.
Yeah, exactly. So, but we soldier on.
Certainly on the legal side of our business, we obviously monitor legislation very closely, and there certainly seems to be no signs of it slowing down. So I guess we can expect more of the same in the coming kind of months and years. Speaking of which, is there anything major on the horizon that our listeners might not be aware of?
It's hard to know because these things just come out of the blue. What we are aware of, I think, are the things that we've already covered off, things like insurance contract law and conduct of financial institutions, those sorts of things. But there's no telling, really, what could happen.
Anything could come up, I guess, in the next few months. So we just have to stay kind of ready for whatever might come next.
The Reserve Bank Act is under review, and that's also proposing that deposit takers will be covered by a separate Deposit Takers Act, and that will require them to also pay into a deposit protection insurance scheme. so that depositors are protected up to $100,000 with each lender.
Right.
And I think that that has major implications, obviously, for non-bank deposit takers, of whom there are not that many left, of course. But we are concerned about the implications of that for our non-deposit taking lending members as well, because it also talks to the supervisory perimeter for the Reserve Bank and whether they will have more overview of the non-bank lending sector than they currently do. So those are the sorts of things that we keep on the radar. But if you asked me 6 months ago what we would be submitting on or what would be our biggest concerns, it would have been triple CFA, obviously, but there's an awful lot of stuff that's come through since the beginning of the year that we weren't expecting. And we've probably made more submissions in this last 5-month period than we did in the previous 12 months.
All of which sounds like we're continuing to go down the road of more and tighter regulation in this space. Yeah. So I guess to put you on the spot before we wrap up, Lyn, if there was sort of one thing about all this legislation that's on the table that's going through currently that you perhaps could change or influence or undo, is there anything that sticks out to you?
Oh, without doubt, the triple CFA. We didn't see that there was any need for the legislation to be changed dramatically. Yes, we understood that there were such things as payday lenders and those high-cost lenders who were potentially causing consumer harm, and so we were supportive of the Act actually defining what they look like, who they actually are, and the Act now defines high-cost lenders as those who lend at interest rates of more than 50% per annum, and it's also instituted a fee and interest cap, so they cannot charge any more than 100% of the loan amount, and they cannot charge any more than 0.8% per day per annum, which is still quite significant. And those are good things. But I think, we still go back to the beginning where we believe that effective enforcement will have more of an effect on consumer protection than a whole pile of legislation.
Precisely. And it sounds to me like the legislation could perhaps be more targeted at those smaller but significant problem areas.
I think if we'd left it there, it would be perfect.
Yeah.
But we haven't. We've taken it that step further, and the prescription that's required, the record keeping that lenders are going to have, the records that they're going to have to keep to justify to everybody, the consumer, the regulator, financial mentors, their dispute resolution scheme, as to how they came to the decision that they did, the lending decision that they made. I think that's a significant part of the new regime that they're going to really struggle with. And what concerns me about that, I think, is that after 1 October, that all those players have the right to request the records as to how the decision was made. That lenders are going to be in this phase of trying to get their heads around the new regulation, but also having to deal with all these requests coming at them. So, I think it's a watch this space, but it's certainly going to be no shortage of things to keep us busy until the end of the year.
Definitely not. And I'm sure many of our listeners are going to be nodding their heads in agreement with some of the things you would like to influence going forward. Now, I just want to thank you for your time today, Lyn. It's been great catching up with you and really fabulous for me to hear a little bit more about the detail of what's happening in this space. Certainly sounds like the FSF and the work you do is needed more now than perhaps ever before. As I said before, I think most of our listeners are going to be familiar with the Financial Services Federation, but if any of you out there are not and you are interested in joining, please head over to www.fsf.org.nz and you can find all the information you need there to sign up and become a member.
Thanks, Lindsay.